Good afternoon and happy Halloween. This is Ruth McCambridge. I'm the editor-in-chief of the Nonprofit Quarterly, and I want to welcome you to NPQ's second of 4 workshops on the new FASB, or FASB as everybody calls it, Nonprofit Accounting Guidelines. This session is on the mysterious, thrilling, and therefore seasonally appropriate topic of restricted contributions, functional expenses, and eye-opening disclosures. So I'm sure you'll stick with us as we kind of make our way through this fun house. There is, as anyone in our work knows, profoundly deep value in those who help translate our financials into coherent narratives for us. We have 2 such people here with us today who will help us all understand how the structures underlying our narratives will change with the implementation of the new FASB guidelines. With the date for the implementation of these new guidelines fast approaching, nonprofits should be doing all they can to inform themselves about the implications for recording, reporting, and planning. We will continue to focus on nonprofit preparedness to tell their financial stories, particularly in this environment of increased disclosure and a focus on transparency and visibility into the policies that drive a nonprofit's financial decisions. So this special 4-part series features Hilda Polanco, founder and CEO of Fiscal Management Associates, and Gina McDonald, lead consultant at FMA. They'll provide financial and administrative staff as well as board members with a heads up about the most critical aspects of the changes that you and your nonprofit will need to make. Today's workshop, I do want to say to everyone who's here, we all owe a debt of gratitude to AccuFund, who is our sponsor today. They're nonprofit financial management specialists who help thousands of nonprofits improve their overall financial management by streamlining processes, improving efficiency, and lowering costs. They're able to share their solutions both in person and over the cloud. Their reporting capabilities and intuitive dashboards enable sound decision-making and strategic execution of your mission. This webinar will be recorded, and this answers the questions of all the people who logged in ahead of time to ask me this question. The webinar will be recorded, the slides will be available later. You guys will all be sent copies of that after this webinar so that you'll be able to share them with anybody in your organization or with colleague organizations as you see fit. We also will be publishing the webinar on our website, so it'll be freely available to people. So don't ask me the question anymore. I always say that to people. It's like I have to make a real point of, please don't ask me that question, but you all do anyway. It's like a ritual. The presentation will last for 1 hour, and we invite you to stay online for an extra half hour after with the presentation in case you want to ask any specific questions about how what we've talked about today needs to be attended to in your own financial systems. If you think of the presentation, go ahead and log it in. If it gets addressed in the remainder of the presentation, I won't go ahead and ask it again. But if it doesn't, it'll give me a way to kind of keep track of what your questions are and how to group them and that kind of thing. So on the right-hand side of your screen is a place where you can log in your questions, and please feel free to do that at any point. We're also on social media, and you can follow today's conversation with, get ready for it, hashtag FASB ready. So that's hashtag FASB ready. So today we'll be talking about the ways that restricted money of various types and functional expenses must be reflected going forward in your financials. This may seem like a fine point of practice, but the changes will actually affect the way your financials look in the future. Gina and Hilda will talk to you about what's changed and how to prep for and implement all of that. So take it away, Hilda.
Thank you so much, Ruth. Appreciate being here with you and with everyone who's joined us. Gina and I look forward to our time together. We wanted to start by just reorienting us all to this new term that comes along in recent years with the FASB, and it's called the Accounting Standards Update, the ASU. And this ASU was issued back in August of 2016. It outlines the changes we'll be covering today, or most of them. It really represented a major revision since 1993, and its effective date is either calendar 2018 or fiscal year 2019, depending on your organization's fiscal year. In terms of the actual focus, it will be on how others can better read, understand, and make decisions based on the financial statements of nonprofits. I would say that that's always been the goal of the FASB at any juncture with any major change. In this particular case, it's more focusing on decision making and understanding the health and liquidity and other items that we will discuss. The key stakeholders are board of directors, donors and funders, and financial institutions that often will review audited financials to assess health and sustainability over the long term. With those stakeholders, we sort of asked ourselves, is this really a change in accounting? Is it a change in financial statement presentation? Is it a change in disclosure, or maybe all of the above? First one, is it a change in accounting? It really isn't. The nature and essence of donations, whether they're restricted or not, remains the same. The donor restriction for an endowment is still an endowment, but as you'll see, it will be presented differently now. So accounting-wise, it is still the same debits and credits we've had before, and the essence of donations remains the same. It is a change in financial statement presentation. The history here was the FASB's effort in trying to make things simpler. You'll see that there are changes in how donations get classified. We used to have a number of classifications, we have less. With respect to presenting expenses, another item we'll cover today, the statement of functional expenses has always been the statement that most closely resembles your budget when you're looking at an audited financial. I always think of it as the statement that really opens up the focus of where you're investing your resources. You'll learn more that the statement of functional expenses is going to be reviewed more carefully in terms of assumptions and what it represents overall for the cost of doing business. So it's about presentation and a little bit of a refresher, as I'll share with you in a little bit. And then significantly in the disclosure area, when you're reading financial statements and you're trying to understand the financial health for decision making, disclosures are really critical. They're in the back of the audited financials in the notes. And in both cases that we'll discuss today and future items that we'll discuss in future webinars, there is enhanced disclosure back to that goal of understanding the information that is presented more clearly. This diagram here presents the 5 areas that the ASU addresses. And if you joined us in the past, we had one webinar that was specifically on liquidity and availability of resources. At the end of this presentation, we have a link to that webinar if you didn't happen to join us. The liquidity disclosures are key. We often think in terms of nonprofit sustainability that cash and cash equivalents are critical. So having that covered is really important. Today we'll learn about net asset classification and net asset disclosures. And so in terms of the net asset disclosures, we are going to learn about how net assets are classified and what they represent. In future sessions, we will be covering statement of cash flows and investment returns, which are part of the ASU, but we will not cover today. So today we're going to cover net asset classification and statement of functional expenses. I'm going to turn it over to Gina now, who's going to start the net asset classification conversation. Take it away, Gina.
All right, everybody. So let's get started in looking at one of the aspects of the new FASB guidance. And I'm sure everyone's been hearing about these changes coming down the pike, and for sure this topic of net asset classifications is the one that everybody's talking about. We just heard Hilda describe 5 different areas of change, but for some reason this one seems to be the one that's getting the most buzz. So let's dig into the details. When we talk about net asset classification, we know today that we're living with 3 net asset categories. For financial reporting purposes, we have unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets, which we see here on our screen in blue. And it really seems like just yesterday that we learned what temporarily restricted and permanently restricted even mean, right? But it actually was way back in 1993. So this has been the first change in this reporting format since 1993. If we look to the green here on the right of our screen, we're going to see that our 3 categories are going to morph into 2 net asset categories, again, for external reporting purposes. What is today unrestricted net assets is going to be called net assets without donor restrictions on our financial statements. We're going to combine temporarily restricted and permanently restricted into a new category called net assets with donor restrictions. What FASB is trying to make very clear here is that restrictions can only be imposed by external parties, and they're using the term donor to refer to various external parties that are funding nonprofits. So it refers not only to, who we might refer to as a donor internally, it also refers to grantors and other funders as well. Okay? So really that's the message FASB is trying to drive home, is who is imposing the restrictions. And FASB really feels like this consolidation is going to make the financial statements less complex, more understandable. Really what they're trying to do is simplify the format of the financials so that we have an improved understanding of the financial reporting. FASB is very, very focused on the readers of the financial statements, stakeholders, those who are reading the financials, making judgments about our organization's financial position, and drawing conclusions based on the financial statements. In our first webinar, actually, we talked a lot about liquidity and the focus on a nonprofit's liquidity. FASB believes that segregating the net assets with donor restrictions is going to make it easier in order to assess things like liquidity and the financial health of an organization. So let's now take a look at a live example here of what our financial reporting looks like today. So of course, we know today we have these 3 categories of net assets. We see contributions in both the temporarily and the permanently restricted column. We see investment return. Okay? Now, FASB is pointing out that by having these 2 columns segregated, it's not really helping to drive home the fact that they're both similar, temp and permanent are similar, and that it's restrictions imposed by external parties. One kind of restriction happens to be temporary in nature, the other kind happens to be perpetual, but they're both derived from an external source. Now remember, in our unrestricted category, however, we do have board designated net assets. So that's when the board votes to set aside or earmark certain dollars. And so there are some self-imposed restrictions But again, those are today they're reported in the unrestricted column, and under our new format, they're going to continue to be reported in the net asset without donor restriction category, okay? Now under the new format then, we're gonna see the very same first column. So what used to be unrestricted, all of those numbers are exactly as they were in the before example, except now we simply have a different heading at the top of the column. We have net assets without donor restrictions. Our temp and our perm have been combined into activities with donor restrictions. And I also want to remind everyone that this format is for our external reporting purposes. In our internal financial statements, we potentially could have 2, 3, even more categories, because internally we have to be potentially more detailed and really understand the different nature, characteristics of our restricted funds, right? So internally in our development records, we might have different fundraising campaigns segregated, right? So this is not affecting our internal reporting. This is simply affecting external reporting in our financial statements. So really each nonprofit has to decide what internal system of record keeping gives them enough detail to ensure we adhere to donor restrictions, and also we facilitate this external gap reporting in this way.
And so now let's look and see what our balance sheet or our statement of financial position will look like before and after this change. And so here we have what we're living with today. And this is a pretty simple balance sheet in that we've got everything presented in one column. Some of you may have more complex balance sheets where you've got several columns, but certainly we have 3 potential categories of net assets here on our balance sheet today. Again, we have the unrestricted, the temporary, and the perm restricted. And of course, those will also mirror and carry the balance forward that we just saw on our statement of activities. So we'll have the same columns presented. We can go to the balance sheet new format, please. And so here in our new format of the balance sheet, let's take a peek here at this net asset section. In this example, it is very extensive, where we have net assets broken out into very distinct lines that give detail as to the nature of each different kind of restriction that's placed on net assets. So if we just sort of scan through those quickly, we see we have net assets without donor restrictions. Again, could include board designated, as this example does, where here we've got $50,000 of board designated net assets. We've got some dollars invested in our fixed assets. And then we have all other undesignated, unrestricted net assets. Also, we're detailing out here what kinds of restrictions our donors have placed on our net assets. We have purpose restricted, time restricted, and then also notice we have perpetual in nature. So the perpetual restriction is what we used to call the permanently restricted net assets. Now, certainly this detail is not necessary to be shown on the balance sheet. There might be reasons we want to show greater detail this way. If we don't present this kind of detail here on the balance sheet, it is required to be presented in the footnote disclosures. So either here on the balance sheet, detailed by line item, or in the footnotes, detailed. We can advance to the net asset classification slide. So as I mentioned, we have a couple of options for how we want to disclose what is now required. FASB is using this word enhanced a lot. We've got enhanced disclosures in a lot of different areas. And so in terms of net assets, we need to be disclosing the nature of restrictions, the amount of restrictions,
and the effects of the various kinds of restrictions. So that word effect is one that sort of, made me wonder what FASB was getting at. And what we're required to disclose is the effect that these restrictions have on our assets and liabilities. So again, this whole idea of a reader being able to make judgments about liquidity, availability of assets, nature of liabilities, really make decisions about the financial health of an organization. Some of you might also say, well, I already have a lot of this disclosure. So if you do, that's great, you're already complying. If you don't have this level of detail, which is quite possible, then, as Hilda mentioned, in calendar 18 or fiscal 19, we'll just have to be disclosing a little bit more about the nature of our restrictions. We can advance to net asset classes. Now, in terms of internal restrictions, again, that relates to our board designated net assets, right? Dollars that we decide, the board decides and votes to set aside for a special purpose. There were not previously requirements to disclose a lot of information about the nature of the board designated net assets. Again, you may have had disclosures, but it wasn't entirely necessary that you disclose. Now we're going to have to, it'll be mandatory that we either disclose on the face of the statements or in the footnotes, again, all the details of the nature of the disclosures. If we decide to disclose in our footnotes and not on the face of the statements, as that balance sheet example showed us, this is one way we could shape our disclosure. We could have a tabular format as this one, where we're giving more detail. Again, what is the nature of the restriction? How much is the restriction? We might even enhance this disclosure with a few sentences if there's anything to tell the reader about the effect of these restrictions on the use of our assets or on our liabilities, things of that nature. So we wanted to sort of show you all that. Not all the disclosures are required to be in words or in paragraph form. Sometimes a table like this one is really helpful and gives a clear picture, especially in something like this where there are so many numbers and really a lot going on in a disclosure like this. So Hilda, I wonder at this time, if you want to give us sort of your words of wisdom as to real life challenges you've seen with folks interpreting the current way we describe net assets, being permanently restricted or temporarily restricted, and sort of weigh in on whether you think this new disclosure and new sort of headings will affect the understandability.
I like the 2-column much better than the 3-column. And one example that I often think about is organizations that have endowments. The original endowment is referred to as in perpetuity. So in this disclosure, it would be under the endowment funds. And in the prior, it might have been on the permanently restricted. And over time, those endowments grow. And the unappropriated portion of that growth today remains in temporarily restricted because the donor gave us the original endowment. We haven't spent down on the earnings, so it remains in temporarily restricted. In this presentation, it would still be restricted in that it came from that donor, and therefore any unspent item would still remain in the currently restricted under donor restriction. The points that you made, Gina, about the board designated operating reserve, today I see audits that I know the organization has a reserve and it isn't even mentioned on the face of the financial. Sometimes there'll be a sentence in the footnotes. This disclosure, I think, is a real enhancement to have the board designated operating reserve. And connecting back to our first webinar on liquidity, having the board operating reserve presented separately helps with that disclosure around liquidity that we spoke about last time. So I think it's a step in the right direction. I happen to like the footnote disclosures with the table format that you have, but I still like to include it on the balance sheet as well, so that when someone isn't perhaps going into the footnotes, they could look at that one page and get a snapshot. I always think of net assets as the net equity of the nonprofit. So this is a really important section of the balance sheet. And the more that you can articulate access to funds, the clearer it will be in terms of its purpose and its use. So thank you, Gina, for covering that part of the new guidelines with us. And we're going to move now to the second part, which is expenses. And so wanted to walk you now through the allocation of expenses, which is the key. Expenses have always been part of what we encounter in the audited financials, but the idea now that functional classifications and disclosure are required for all nonprofits, that's the big headline. Currently, before the new changes, expenses only have to be reported on a functional basis for organizations that are called voluntary health and welfare. These are organizations working directly with the public, not necessarily a black and white definition, but going forward, it's not just voluntary health and welfare. All organizations are going to have to disclose it either on the face of the statement of activities, as a schedule in the notes, or as a statement itself for the statement of functional expenses. I believe the third option is really the best option to show what is in each of the functional categories. The headline in the change is the disclosure of the methods used to allocate these expenses is now required. And so just to remind us as to what do we mean by functional expenses, if you think of expenses in the natural categories, we may have salaries or rent or utilities. That's the nature of the expense. But in the nonprofit sector, the activity from a functional perspective needs to be thought in a different dimension. And that is, even though I have salaries and rent and utilities, how much of that is for programs, how much is for management in general, and how much is for fundraising. So think of it as a second dimension to the expenses. In order to get from the natural to the functional, we need to use something called an allocation methodology. Again, this has always been required. It's a methodology by which we allocate costs that are not specific to one activity. So we might have something specific to program or specific to administration. But the actual allocation methodology allows us a well-documented approach to doing that. The methodologies that are possible, this is not a one-size-fits-all. This is very much based on how you utilize your resources. The number one expense category, as we all know, for nonprofits is personnel. So how do personnel costs become allocated across those functional areas? We are a big proponent of staff level of effort. Where does your staff spend their time? Not necessarily on salary dollars, but on their level of effort, also known as full-time equivalents. In addition to personnel, we have a group of expenses that are occupancy related, and that might include your rent or your utilities. There are some ways to allocate occupancy, and that's based on how your space is utilized. Here, I'm in the New York office today, and space in New York City is really tight. And in the morning, space might be used for an administrative meeting. Midday, it may be a programmatic activity, and we may have a board meeting in the evening or a fundraising event. That same rent is being paid for space that is being utilized for many different activities. So you will need to decide what is the best methodology for your occupancy costs, and we think they belong as a group. You may have interest, insurance, depreciation, all also related to occupancy, but depending on what the asset is being used for, that will dictate how you allocate it. These methodology concepts have always existed. Just to connect to the Form 990, these allocations inform the audit, which inform the 990. So again, The fact that this was expected all along remains. The difference is that now we are disclosing how we actually are doing the allocations, and I'll show you some disclosures in a little bit. I did want to make a connection, though, to the idea of tiers of cost. So the statement of functional expenses is in the audit. We'll get to see a picture of it in a little bit. But in our world, working with nonprofits, we like to make the connection between the audit and the actual world that we're operating in terms of what does it cost to deliver our services. So think of the cost structure of an organization as having 3 tiers. We have the direct program expenses, which are the expenses that are being utilized in a direct activity, the caseworker for the program, the fundraiser for the fundraising event, the accountant in the accounting office. Those are direct expenses, whether they're program or otherwise, for that activity. And when it comes to program, those are the costs that most often are fundable from the outside parties, whether it be government or private grant makers. That's tier 1, fairly easy to understand. We have a second tier of costs that we call the misunderstood expenses. That's the tier 2, and those are the shared costs. And that's really where the statement of functional expenses becomes critical. When we're sharing costs across functions, we want to make sure that program expenses include the fair share of the use of the shared space for programmatic activities. So that example of rent, we want the program costs to reflect a portion, a fair share of that rent expense. Across the board, we want all of these shared expenses to be broken down between program, administration, and fundraising. Tier 3 is the last tier, and that's the management in general. And that, again, is an outcome of allocations, but that is really what remains in the administrative and fundraising costs of an organization. So knowing those 3 tiers become really important in terms of how we bill for our costs and how we go out and raise funds for our programs. So this is the statement of functional expenses. When we work with organizations, there's a couple of things we like to highlight, and I want to connect it back to the enhanced rules now of the allocation process. So for this organization, there are 4 programs, program A, B, C, and D. And those are called program services in the audit, which then translate into the 990. But I want you to also think of this as the way your budget should be developed. Programmatically, if we want to know what is the full cost of running program A, even before we consider contribution to overhead, that is going to be the total for the column called program A. In program A, you will have both those direct costs associated with the program that I call tier 1, but you'll also have the tier 2 expenses. For example, you could see that rent has been allocated across the board, and program A has been allocated $97,000 of rent. Program A has both tier 1 and tier 2 in that total cost example. Program A's total cost of $357,000 will be transferred over to the 990. That will be the total cost for program A that will be disclosed. Management in general will be the amount indicated here, and fundraising. So there's a term that we have lovingly come up with in the sector called overhead. When you look at your statement of functional expenses, overhead are those 2 columns that in the audit are referred to as supporting services. The statement of functional expenses is prepared at the end of the year as part of the audit, and it is something that actually is informed by this allocation methodology. We again believe that it has tremendous value if looked at as an actual management document, as an actual indication of costs of running the organization, and as part of the statement of functional expenses. In a minute, I'm going to talk about disclosure and what you need to show that's more than has been in the past. But Gina, I'd love to hear a little bit more from your work with nonprofits. What have you seen as some of the challenges in using the statement of functional expenses the way that I'm hoping that organizations will use it?
Yeah, definitely. So using the statement of functional expenses as a tool would really require that we actually have the information allocated throughout the year, allocated and ready to be reviewed, say on a monthly basis with our monthly financials, things of that nature, have timely and accurate reporting on this functional basis. What I've seen many times, as you mentioned, this tier 2 group of costs sort of, hanging out unallocated during the year. You mentioned the direct tier 1 costs. Those are fairly straightforward. So those generally in practice, we're able to, code those expenses to the correct programs that are benefiting, where the resources are used. Certainly direct management and general costs, fundraising, again, they're more straightforward. But where we have, clearly none of us want to think that allocations happen without effort or work. We know it's a time-consuming endeavor, potentially. So what we see sometimes is tier 2 being left unallocated because it does require thinking about the best way to share those costs, trying to represent where the resources are used. And what I hear a lot is, well, my auditor does that for me at year end, right? Yeah. And so, or we do that for the 990. But really, so what we're left with is, maybe not reports, say on a monthly basis, that are showing us the true cost of each different program or activity. So we know and we acknowledge, we have to find an efficient way to spread those tier 2 costs.
And when I work with development directors, and I try and make that connection that this is not an annual audit function, but actually a management tool, when a development director looks at these columns and actually makes the connection that this is the budget ready for grant writing. This is program A, this is what it costs us, and even if a grant maker is only able to make a grant of $100,000, I am now leveraging the $100,000 grant with additional funds that I will raise to cover my full cost of $357. When you're actually going to raise funds, you want to raise funds for program of this amount and then ask the foundation or the government entity what is the percentage that they will allow towards overhead. So we don't want those tier 2 costs to remain as leftover into overhead. That will inevitably contribute to a deficit because the organization is not covering all of its expenses. So again, this is today required for some organizations, but the totals of program admin and fundraising are required in general, either on the statement of activities or in a footnote, and then again in the 990. So what's different on the disclosure? Today, this could be a sample disclosure, and you typically would see this in note 1. So note 1 is the note that discusses all of the different accounting policies. This would be in there, and it would say something like the cost of providing these programs and activities are summarized, and these costs are summarized by function, and costs have been allocated based on services benefited. This is typically what you see in note 1. In the future, this is actually going to be either part of note 1 or as a separate disclosure, and you can see the difference. We're now not only saying that expenses have been categorized across program or supporting services, but we have to say something along the lines of it's an allocation methodology that's allocated on a reasonable basis that is consistently applied. So this is how we do it. This is how we always do it from the consistency place. So if we're comparing year to year, it's a comparable. If we're going to different funders asking for an overhead rate, it's based on a consistent methodology. But then it goes even further to say the expenses that are allocated are tier 2 expenses, are depreciation, interest, and office occupancy. So it specifically says what is being allocated, how it's being allocated, in this case on a square footage basis, and then salaries and benefits are allocated on a time and effort. So you've had an allocation methodology for a while and you can't really recall how it's being done. Now is the time to refresh it, and with it, any chart of accounts that may need to be revisited. So again, look at this disclosure and ask yourself, could I say this about my current methodology? Do I feel comfortable that I can disclose it in this way? And if you can, terrific. If you cannot, then this is where you would want to work on. In terms of additional thoughts, so when is it effective? Again, this is the technical way that the FASB describes it. Fiscal years beginning after December 15th, 2017, which means calendar 2018 or fiscal year using June 30th, for example, the beginning year of July 1, 2018. And so we want to keep flashing this in front of you in the months to come. We want this year to be somewhat of your dress rehearsal for your calendar year organization. So think about your 2017 disclosures and what you might want to do. You want to educate the members of the board on the new requirements. I encourage you to talk to your audit firm, and if they haven't already, have them talk to your board when they present this year's audit as to what the next year changes might entail. Take a look at the board's intentions around any board designated funds and look at the documents that exist. You have board designated reserve policies. What is, again, this is relative to the liquidity conversations that we had last time. In terms of today, what are the intentions on the donor restrictions and those disclosures, and on the internal disclosures? Seek professional advice from anyone who can help, any advisors, help you prepare for when the audit does have to be done. And again, as I said, use it as a dress rehearsal for 2018. Just a few more thoughts, and then I'm going to come back to the questions. And as Ruth mentioned earlier, we have a core program that's an hour, but we are willing to stay a little bit later for any additional questions that may come up. So in terms of the next webinars on this topic, already in 2018, we're going to talk about disclosures and more disclosures associated with cash flows, investments, and endowments, which are the remaining areas that I mentioned. And May, we want it to be a moment of celebration. If we pull this all together, what are some implementation strategies and tips for how to disclose the information in the new requirements, how to think about it? And we are building an implementation tool that we will share with all of you. Again, if you missed part one of the requirements, here is your recording for part one. Whenever we join you, we always remind you of Strong Nonprofits. It's a website that is available on strongnonprofits.org. It is covering the areas of planning, monitoring, operations, and governance. And there are 2 webinars, an hour long, that walk you through that website. If you don't have an hour, but you have 15 minutes, there's the on-demand there. In the coming year, we will be revisiting Strong Nonprofits, and in any documentation that speaks to disclosure and the guidelines as per the FASB, all new documents will be developed to represent the new regulations according to the FASB changes. So in the next year, Strong Nonprofits will also have tools to discuss the new changes and how they should be thought of. So thank you again. Now we're going to turn to questions, and I'm here, Gina's here. Back to you, Ruth, on any questions that may have come up already as we have been going through the webinar.
Great. Okay, so I'm gonna almost work from the back in terms of some of the questions, and people can continue to log in their questions as we move forward during this next little period. So there was a lot of questioning around strategically what's best in the functional expense category, and I can imagine that you probably know that where this is coming from. For some nonprofits, they're still struggling with how much how much overhead they really want to reflect. And so there were a number of questions about, is it appropriate? I don't know how else to say this, but are there strategies for hiding overhead? That's basically the question. And is it a strategy to hide overhead? Are you, when you are really being very clear about what programs the functional expenses are being allocated to, how does that affect how you report out on overhead? That's basically the question that people are asking.
Okay.
Does that make any sense to you?
It does, and as Gina said, this is national.
In the trenches, that is the question.
So to repeat what Gina said, national TV, great question. So overhead, the term overhead does have some negativity associated with it, and we wanted to make the connection back to the statement of functional expenses, because that is the publicly available document, and it is your opportunity to tell that financial story. We realize that there are certain funders that only will fund certain percentages, and that's the reality, and that's the cost of doing business with a funder that does not cover the full overhead based on your organizational structure, based on your budget. The first step to funding overhead is to recognize that it exists. And in the statement of functional expenses, if you use it both as a budget tool and as the document in your audit, that is the first step of telling that story. When nonprofit, when the conversations happen with funders, they go to the audit. They understand that this is where the allocations begin. If 1 year 15% is all the grant maker can cover, then again, you at least know that if your overhead is 20 or 25% and you're only receiving 15, you have some additional portion to raise. So what your funder is willing to pay is one thing, and what it really costs you is another. We encourage all of you to start with, to the best of your ability, these are estimates, start with understanding what that cost is. But for this conversation, the fact, let me bring you back to those tier 2. If you don't take the time to say what portion of my rent or utilities or insurance is really related to the programmatic activity, then it's an uphill climb from that point, because you even have a bigger portion of what some would call overhead. So start by moving over, and I sort of describe it this way because we're moving it into the programmatic columns. Start there so that you have at least a fighting chance of how much you'll be charging your funders. That tier 2 is what we've seen to be the real game changer in arguing, as you should, that these are programmatic costs, that they are not overhead. So starting there will be, and it's not about hiding, it's about properly reflecting what the costs of running the program are on an inclusive basis. I hope that helped.
Good answer. Good question, good answer. Somebody else asked how this effort might impact the development of a federally negotiated indirect cost rate. Do you know the answer to that question?
So the federally negotiated indirect cost rate is, again, think of the federal government as a funder, and they have a very specific formula for how they do the federally approved indirect cost rate. In the process, the outside, if you have an outside advisor who's helping you formulate it, or when it's being audited, there is a part of the process that connects back to the statement of functional expenses, but the federal government is very particular about what they include and what they don't include. So the federally approved indirect cost rate is only that. It's the rate applicable to the federal government. While some other funders may accept it, it is a very specific calculation, and one that is sort of a world unto its own. If you do business with the federal government, absolutely go for it. But if you don't do either direct or indirect business with the federal government, This is the more generally approved way for audits and 990s as well.
Okay, the next question has to do with when all of this gets done. So there were a number of questions, a number of people who asked, you know, is there any, are there any adjustments being made in QuickBooks or other software programs that do these allocations as the year moves forward rather than all at once at the end of the year or, you know, every quarter or so? Do you know if software companies are making plans to try to make this a little bit easier for people so that there's a pre-planning process that can result in a little less angst about this?
Sure. Gina, do you want to take that?
Yeah, I think the pre-planning route that you just mentioned is a key as well in this whole consideration of allocations, because as Hilda mentioned, that functional expense schedule is what most closely represents your budget. You've got one column for each specific program or activity. So really this consideration of where costs should be charged and how we share costs really begins at the time of budgeting. Because then month to month, as we're comparing to our budget, if we didn't set up our budget with these allocations, our comparisons to budget are going to be pretty tricky. So really we've got to think about what things cost and where we spend resources at budgeting time. Then a really good accounting software package will let us input the budget into our software. So that would be the next thing to do, is to have it preloaded in there. And to get a little bit technical for the accountants with us today, ideally we are budgeting based on our internal accounting chart of accounts too. So everything's sort of on speaking the same language. Then there are softwares today that do have the capability to allocate on an automatic basis if we preload. We can preload based on different vendors or based on different kinds of expenses. It can split those up, if you will, so we don't have to sort of do calculations on the side and things of that nature. I'm not aware of any enhancements or modifications being made to existing softwares, but this definitely is a focus, I'd say, of software companies in general, because they're really taking a look at nonprofits and investing time in the tools, because they know there's a lot of really detailed record keeping that nonprofits have to do. So I'd say yes, it's available for sure.
And this is a similar question. Did you have anything to add to that, Hilda, or your?
No, yep, that's great. I was just going to say that this is the one when you hear about fund accounting, allocations on an automatic basis are a key feature that whether the software is fund accounting in its traditional terms, or it's a more current system that integrates with other systems but has allocation capability, that's what you would want to make sure you have.
Right. Okay. So this is a similar question, I think, and it just has to do with, you know, how keyed is one part of the system to another. Are these changes going to be reflected in the A133 audit?
I can speak.
Sure.
That, I think. Yeah, so now we are living with this new version of the A133 guidance called the Uniform Guidance. And so the Uniform Guidance has been around for a few years now, and this would come into play for an organization who expends at least $750,000 of federal funds. So when we're expending that much in federal dollars, we need to have this special second compliance audit performed. And so when that happens, the auditor is using guidelines in the Uniform Guidance. So that's completely separate, just like when Hilda mentioned the federal indirect cost rate. Sometimes we refer to that as our NICRA rate. that's more in line with what's happening in a uniform guidance audit. So again, that's different regulations having to do with compliance related to your federal grants. So in those situations, when we have a uniform guidance audit, what we want to make sure, number one, is that we know all of the compliance requirements for all of our federal grants. That is the determining factor with what we can request from the feds for reimbursement from our grants, right? What we're charging to grants, what we're billing the feds for, has to be in accordance with that very particular grant agreement. Now, internally, we might have, I'll use any kind of federal program as an example. I think it's easier. We might have, say, a Head Start program. So we might have a classroom that's partially funded by a Head Start grant. So the cost to run that classroom may be much larger than the portion just covered by Head Start. So we sort of have two things going on. We have this large pool of costs to run the class, and we're going to account for those, as we just discussed, on a functional basis in accordance with GAAP. Then we've got a smaller subset in there, the cost that the feds will reimburse. That's the uniform guidance stuff, and that's what the uniform guidance in our grant will be the master for that, for recording to the grant. So the grant is like a subset of the larger costs, if that is helpful.
I want to go now to the issue of reserves, and I'm going to ask some questions, some of which are pretty basic, but the first question was, what goes in the category of donor restricted? Because this person was asking, well, what exactly do you mean by donor? Does that include contracts? Does it include foundations? Who's included in the category of donor?
Sure. So FASB, yeah, I thought that was interesting as well, the selection, the word choice, donor. And they have mentioned that when they use the word donor, they do mean various kinds of different parties, individual donors, foundations, some grantors as well. So they specifically have called out different kinds of funders fall under this donor category. It's not just an individual donor. So definitely could be a corporate sponsor, right? A corporate donor, could be a foundation as well. The only time that something or a source of restricted dollars would not fall into this donor category is if we have any, you use the word contract, any fee for service contract. So for instance, we're charging for services like we've got memberships, or folks pay us tuition. So not contracts where we're being paid on a fee for service, but it seems to encompass most other sources of funds.
Do you have anything to add to that, Hilda?
Nope, that's exactly it.
Perfect. Okay, so another question well, there were a number of questions like this, is how, and you may have already addressed this, but how do reserves that have to be authorized by the board get recorded? You discussed a lot how endowments that have to be authorized the board get recorded, but how do reserves that have to be authorized by the board get recorded?
Gina, you want me to take that?
Up to you.
So there's reserves are, sometimes they exist because they're in the bank and we're not spending them, so there's available dollars there. And then there are reserves that are clearly designated for a particular purpose that the board identifies. And that is one of the points of clarity that comes through this new guideline. If you have a board designated reserve, meaning the board has designated its purpose, that has to be classified as such. It is the board can change their mind. The board is not a donor. So therefore, it's not donor restricted. It's within the purview of the board. The purpose of the disclosure and the clarity around liquidity is, what is this for? So when you say, Ruth, that it needs to be authorized by the board will authorize its original creation and the designation, and also at times will indicate, if you take from that reserve, do you need to pay it back? Do you need to have a certain level of authorization to request? All of that would be in a board designated reserve policy. So it goes under no donor restriction. It's a board designation. In the newer requirements, you need to say what it's designated for. And we come across many board situations where they have some extra cash, but they've never really thought about what is its purpose, don't have a policy. And this question now of how do we intend to meet our obligations, which is the liquidity discussion, it forces the question of, does the board have a designation, and does that need to be clarified? That's why, in a sort of indirect way, required disclosures are now forcing the clarity around what is the designation that the board has created. So we'll always be in the without donor restriction, again, because the board can change that over time.
So whether or not a reserve would be considered kind of as positive liquidity would be dependent on how you characterize it yourself.
And how available it is for the organization. If the board designated reserve is tied up in equity securities at a brokerage house and they're invested for the long term, that's not really available in terms of the board's policy to meet payroll on Friday. And so that's not as liquid as it might be otherwise, if it was in a checking account available to the executive director when needed. So those
okay. Here's another fairly, it's a related question. How is the release from in perpetuity reported when an endowment is spent down?
Beyond the original principal, I guess is the question. So when it's spent down, meaning we've used the original principal. I'm assuming that's the question that's being asked. Yeah. Gina, do you want to take that?
Yeah, and so endowments also really sometimes get into legalities as well. So today we're talking about how to do our accounting, and sometimes I also like to remind folks that sometimes accounting, we're like historians. We're sort of doing the record keeping for something that's already occurred. So really we have to presume that we spent down our principal appropriately and within all the legal, guidelines. So if we did, then it would be released as we do today. In the new form, it would be a reduction, a reclassification out of the net assets with donor restrictions and move over into net asset. Did I say it backwards? Net asset with donor restrictions would be the negative, and we'd be increasing net assets without donor restrictions. So it'd be a reclassification like we do today with releases.
So here's another question that's a very much kind of in the trenches question, which is, if the donor restricts a gift that they're making to you, but it is to an already budgeted expense, do you characterize that as restricted or unrestricted?
So really the question is,
I mean, you're going to spend this either way.
Yeah.
That's the basis. You're going to spend it either way, but someone says, but I want you to spend it this way.
Yeah.
Something you would have done is anyway, probably spent out in that way.
Yeah. So now,
is restricted or unrestricted?
Yeah. So now you're right. We're in the trenches of real life, right? So in real life, what happens is you say, well, I wasn't thinking I was going to get funding for to pay the salary of my development director. but how nice, right? How nice, surprise, someone gave me $25,000 to fund a portion of this person's position. So long as the sum total of all the dollars you got to fund the development director's salary do not exceed the salary you paid the development director, right? The person makes more than $25,000. In practice, folks, accounting would tell you would put it in temporarily restricted and then release it right away, release it as you're paying the person. So no, you don't have to, think up a new expense. You can use it for already budgeted expenses. Yeah. And in practice, sometimes folks don't park that in restricted. In practice, sometimes they just put it to unrestricted because they know it's just going to go in and out. Yeah, and that's, and just again, in the trenches moment, there likely is a footnote in your either note 1 or 2 summary of significant accounting policies that will tell the reader of your financials if you do that. It'll say something like, restricted dollars that we receive and utilize in the same year show up as unrestricted. It'll tell the reader we don't park it in temporarily restricted, we shoot it right to unrestricted because we know we're spending it.
The same questionnaire, which I think this is actually funny because it will come up in some people's minds, but he says, well, what if you're a cancer organization and the funds you receive are for cancer, are for addressing cancer? Is that restricted or is it unrestricted?
So if the FASB is explicit where it says a restriction is more narrow than your mission. Right. It's actually explicitly stated in the standards update. So if your mission is to cure cancer and they give you dollars to fund curing cancer, it's pretty explicit that that's narrow enough to be a restriction.
Right.
Yep.
Okay, that's great. I think all of these questions actually do come up as people are thinking these things over. So I want to give you guys a chance, any parting words that you have for our participants today?
Gina, do you have anything? I'll wrap up after you.
Well, I mean, I guess, sort of where our questions led us, is where I thought they would lead us, in that really, we likely understand the overarching concepts, but the devil is in the details. And sometimes when we go to apply, to the real life examples in our accounting department, we start to question. Absolutely. So I would say everybody's in the same boat in that regard. And so really, sometimes I say, it's, we likely had the right gut feeling, we question ourselves, but I'd say that's probably everyone's in the same boat with that issue with implementation for sure.
Yeah, and okay, so I have one parting question that I forgot to ask before you go out, Hilda, and that is it okay to lump all of your functional expenses into one line and then distribute them across program categories?
I'm having trouble understanding that question. Is it maybe lumping all administrative costs and then distributing them? I'm not sure I understand.
I think that is what they.
Yes, and some organizations do that. They'll have them all showing on the supporting column and then show one number to redistribute. It's for purposes of Tier 2, those program expenses that are shared with administration and fundraising, like the rent and the utilities. I would suggest not doing that technically, and the 990, that doesn't work. The 990, actually, they want to see how much rent is going into the program column. So I think it's a better option to spread it. What I have seen some organizations do is after you've spread the shared costs with what's left in supporting service and fundraising, maybe share that across the programs all the way at the bottom. And the argument there is supporting services are there to support the programs. And so if we allocate all the administration way below the line, what would the total be? That is a pretty sort of simplistic view because sometimes those costs are covered by unrestricted funds or other activities. So I say don't lump one number, actually break out what it represents so that when you're looking from a column perspective, you've got the full cost articulated fully for purposes of fundraising.
Great. So any final comments from you, Hilda?
I would say back to that preparing for the change. You don't really know what's going to apply, as Gina said, until you get into it. If you're a calendar year, when you're going through this year's financials, you may want to do what's called pro forma. So if we were doing this in the new world, what would it look like? If you have board designated funds, I totally encourage you to think about what the disclosures are there and whether you need the policies. And with the statement of functional expenses, again, use it to your advantage. I've been working with some very large organizations that have used words like refresh, revisit, because it had, after a matter of years, just become an audit process. We want you, the management team, to own that. And the very young organizations, sometimes I see very surprised when they actually sit down and look at what these columns represent and how they're telling their story. So look at how you present yourself from a development perspective and make sure that that story is consistent. Just one final thought. People often say, well, I have a few activities. Do I have programs? How many columns should I have? If you're raising money for that activity separately, it should have its own program because that represents probably a different set of clients with a different set of outcomes. So the columns should be that are represented rather than one column just with programs. So those are my parting thoughts. I wish everyone the best in getting ready. And again, speak to your accounting, your audit firm, and ask them what they think you should be focusing on.
And we will see I want to thank Gina and Hilda for this session. I think it's been very informative. And I want to remind people that we have 2 more sessions coming up. Okay, so watch out for that in February. And in the meantime, I'm going to be talking to Hilda because we have gotten a lot of questions that just are not on topic, but they are on financial topic, but not on topic to what we were talking about today. And at some point, we should probably have a more general ask the experts on financial matters. So we'll be in touch about that. And those of you who participated today, thank you very much. There's a huge number of you, a huge proportion of you still with us. Thank you very much for coming, and look out for this webinar to come to you by email within the next few days, I think. And so I will see you all later. And I do just want to note that everybody came dressed for the holiday today. So I want to thank you, Hilda and Gina, for your participation in that. Talk to you later and have a good day. Bye.
Bye-bye.
Thank you.